Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Hello everyone and welcome back to Cash Talk, and today I'm joined by JK. JK, how are you, man?
Good, mate. How are you?
Not bad at all. A few things happening in my life. What about yours, man?
Yeah, a little bit going on. We got our honeymoon coming up in about 5 days.
Oh, awesome.
Not that anyone's counting or anything.
Awesome. What countries are you going to?
So we're starting off in Switzerland. So we're going in Zurich, Geneva. Geneva, we're going over to Paris. Paris, we're going down to Nice, and then Nice off to Greece, doing some of the Greek islands, Athens, and then coming back home.
Sounds horrible. Are you going to some new places or?
So Switzerland's new. Greece is pretty much like we've been before, but all the islands are new. And Paris we went to last time, but I sort of copped a bit of food poisoning, so we were there, but we didn't really see it. So that's why we're going back.
Gonna go do it properly.
Exactly.
Sounds amazing. Now, I could talk about holidays to the cows come home, but we want to get into a very popular topic, and that's around family trusts, okay? And, you know, there's always buzzwords in regards to finances. Family trust is one, debt recycling is another, but I really want to kind of get into like what they are, what they're about, what they're used for and stuff like that. So do you want to explain just in a nutshell what actually a family trust is?
Yeah, so, and it's a really good question. It's a little bit weird when we think of these entities in general, like even companies and even, for example, super funds. They're essentially like their own entity. And even though they're not like, for example, person that's sort of living and breathing in the eyes of the tax law, they're kind of their own individual body, if you like, or entity is what we call it.
It was interesting because I was actually explaining this to my 8-year-old.
Yeah, right.
And he's like, what do you mean?
Yeah.
Like, do you just like make this thing up? I'm like, there's like the law that kind of makes it so you can kind of create these, like you said, entities or these persons that aren't living and breathing. And I could hear, like I could see him thinking like, how does that work? Yeah, for all intents and purposes, it can own stuff and it can act on behalf of things. Yeah, so it really is its own structure, its own entity, as you've put it, and its own persons, but just not living and breathing.
Correct, yeah, and it stands on its own. So if we talk about, for example, when we talk about owning assets in a trust, like if you, and I'm sure we'll get into this later around the estate planning piece, but any assets in that trust or company or whatever it is, they're owned by that trust. So even if, say, you're the person controlling that trust and you pass away, the assets of those trusts don't form part of your estate because it's its own sort of entity again.
Yeah. And when it comes to a family trust is a discretionary trust. Now, the literal term of a family trust does slightly change from a discretionary trust as well. So people say they're exactly the same. Not really, yeah. It's like 98% the same, but there is a slight change. And the change is around like a discretionary trust is you have full discretion. Corporate beneficiaries, individual beneficiaries, which we'll get into in a moment, whereas a family trust really ties that in just into the family. Yeah, the family unit is where... in a way, from an estate planning piece, it makes it much more protective with it being a family trust because there's clear, distinct beneficiaries of how the money flows down. And sometimes this is where family trusts are sometimes referred to as blood trusts, because they're coming down the bloodline itself. But, you know, a lot of the trusts we see, they want full discretion as much as you want that because you want flexibility on, say, taxes and how you do things. So, you know, like I said, it's very much like 98% the same. But if you kind of research it, you'll see that a family trust is I think it's called a family trust election. Yeah, that makes that difference.
Correct. Yeah, and then so there's a few roles in this trust as well. So what happens is usually when you go to create one, there's a trust deed, which is essentially this forget how long they are. They all sort of vary in sizes depending on how many rules and stuff that you're putting in place. But there's a few main roles to sort of know about. One of them's the appointer, and that's essentially the person they've just got one job, and that job is to hire and fire the trustee.
Pretty important role, though.
It is a pretty important role.
Yeah, because the appointor says to, let's assume JK is the trustee, are you doing your role? And that person ultimately is in control, because that person can go, hey, mate, you're out. I'm putting someone else in. And the appointor the existing trustee might be someone or an entity that is in control that the appointer doesn't like. So the point of the person of the appointorship,
they're in sort of ultimate control.
they're in ultimate control. So it's very important who's in that role.
Correct.
And if we find that a big issue is that no one takes these, not no one, but a lot of people don't take these roles seriously enough. They speed to just get this trust set up. They don't take it properly and think about the different roles that are in play.
Yeah, correct.
So we've got the appointer, hires and fires the trustee, and we talked about their role as trustee. So what is the role of a trustee?
Yeah, so the trustee is essentially the person or entity, because
You can have a corporate trustee, which is, say, like a company, or you could have an individual or a couple, for example.
Correct, yeah. And they're essentially in charge of like the day-to-day operations of the trust. So, investment decisions in the trust, setting up, even, for example, setting up bank accounts. You don't need the appointer to sign off on the setup of the bank account. It's the trustee that signs off on it. So it's like the day-to-day operations and the decision-making of what happens within that trust.
Yeah. And what's their role? Like, as much as it's the day-to-day operations, what's their goal? What are they actually doing?
Yeah, good question. So essentially their job is to manage the trust on behalf of the beneficiaries.
Yeah. So they need to act in the best interests of the beneficiaries. And in the trust deed itself, it's usually worded in that particular way.
Correct.
That it says that the role of the trustee is to act in the best interests of the beneficiaries, because the trust is essentially set up and established for the beneficiaries, which we'll get to in a moment, okay? Now, there is also, before we get into beneficiaries, there's also another role which is called a settler. A settler is the person who helps put a dollar amount to start or establish the trust. And usually it's a very nominal amount, $1, $10, $20. Like, it's very nominal, yeah? And it's usually like the lawyer or the accountant that does this as part of the process. But it is, if you see another role that's in there or get asked around the settler, that's who the settler is. So, and then now we get to the beneficiaries. Who are the beneficiaries?
Yeah, so it's essentially, there's a few different ways that you can essentially name beneficiaries in a trust. So the first way is kind of what they call like named beneficiaries, or sometimes they call them sort of primary beneficiaries, where in the trust deed it specifically says, for example, John Cachia, so on and so on. These are the specific people that are beneficiaries of the trust. Then you can go into classes of beneficiaries. So you can, for example, say any grandparent, great-grandparent, children, great-grandchildren, auntie, uncle, niece, nephew, spouse, associate of any of the named beneficiaries. So we can sort of start to see now, in regards to who you can distribute to, starts to get very broad, especially when you start having terms like associate. It's like associate could almost be anyone in a way.
Yeah, and then even like entities of, or associated entities of. Correct. And that's where we get that widening happen. But this is where I believe the distinction between the family trust and the discretionary trust changes, because you'll see in a family trust, it's like this lineage. The primaries are maybe the mum and dad, the secondaries, whatever, and you've got this generational. So that the beneficiaries is also where there's a lot of time spent. Yeah. Not so much on the settler as there are as the appointor, the trustee, and the beneficiaries. Yep. And the beneficiaries, as we said, the trustee needs to act on behalf of the beneficiaries, because ultimately the trust is set up on behalf of the beneficiaries. They're holding the assets on behalf of the beneficiaries. Correct. Yeah. And this is where even some assets, and please don't take this like, go seek advice before I tell you this, because it's a much longer answer. But this is sometimes where you'll have like a car that's owned by a trust, and you can transfer that car to the beneficiary without paying stamp duty, for example, because let's say the car is actually just held on behalf of the beneficiary. And so you have to go through some hoops to kind of do this, but it's like, okay, well, it's still the same beneficial owner.
Yeah.
Yeah. And so if you think about it from that side of things, and I'm talking like that, you can see that the beneficiary, though it's not entitled to a specific amount because there's discretion, this is where the discretion is, it's held on behalf of that beneficial owner.
Correct.
Yeah. And so when we now talk into, for example, those roles, you need to be very important. Now, because family trusts and discretionary trusts are set up with that discretionary nature, the trustee is not obligated to give to that beneficiary a specific amount. Correct. Where that differs to a company or a unit trust, where the unit trust holder has a specific allocation of the profit, the asset, whatever. Company has a certain amount of shares in that company, and therefore the trustee has the obligation to move things around. Okay. And from a tax options perspective, that can be pretty handy.
Yeah, very.
You know, you can have, say 4 beneficiaries or 4 primary beneficiaries you want to shoot out to. 2 are really high income earners, 2 are smaller, lower income earners. You might want to kind of distribute more in patterns towards lower income earners, not the higher ones. Certain things like that give you the ability to move things around. Also, corporate beneficiaries as well, to in discretionary trusts, is around like pushing that money out to that discretionary, holding the profits in that company, paying the dividends, and then shooting it out. So it's what I like about trusts is it gives you options. Yeah, and it gives you the ability to make decisions that you couldn't have made with those investments if they were held individually.
Yep. Absolutely. And I think then, so that's kind of obviously the roles in the trusts. And there's really 2 main benefits of having a trust. One is from a asset protection perspective, and then the other's from a tax perspective as well. So it's really, like, I guess we'll talk about both of those. But from a tax perspective, you've really got that ability to distribute the income to the beneficiaries, kind of like what you were saying earlier. And then if you kind of run out of beneficiaries to distribute to, and this is what a lot of people don't actually know about trusts, is any income that's earned by that trust has to be distributed somewhere.
If not,
you're paying tax at the top marginal tax rate.
Yeah.
So you really want to aim to distribute to someone. And if you do kind of run out of people to distribute to that are on sort of lower marginal tax rates, that's when you've got the option of going, well, let's distribute to a company because that company can hang on to or retain those profits and not need to distribute them.
And that company will pay that tax. Like, it will pay it at the company tax rate.
Correct.
Yeah. But at least it allows you to hold it there.
Yep.
And so, there's that which needs to be mindful of. But what about, for example, there's other things that they need to take into consideration as well too, like losses, JK, as well.
Yeah, correct. So there's even, for example, because like we said earlier, it's this entity that stands on its own. A common sort of thing when people go buy property is having it negatively geared so then they can offset it against their personal income and they're paying less tax. If you say, for example, go buy that property in a trust and that trust is negatively geared and there's losses each year, you can't actually distribute those losses to any beneficiaries. Those losses have to stay within that trust. So you're not actually getting any of the benefits of negative gearing
At the beneficiary level.
Only once then you start to earn a profit inside that trust can you offset those losses.
Yeah, or capital gains, gains on those losses that you can really realise that impact,
Correct, spot on. So they're not always the right thing for everyone. Like, we were talking to a client recently and it was like, hey, we're buying an investment property. We're thinking about buying it in a trust. And then all of a sudden, like, yes, in an ideal world, it sounds like it makes sense. But then you're going to have, there was, I think, 6 or 7 years until this property was going to be positively geared that we were sort of projecting. So it was like, well, for those first 6 or 7 years, you're going to not be getting any of the tax benefits. So you're going to have to be coming up with the cash flow to sustain this trust and then still paying the same tax that you're paying at the moment. So where's this money going to come from?
Yeah, coupled with, especially in Victoria, you've got, surcharges in regards to holding properties in trusts and whatnot.
Yep.
Sometimes property in trusts, when we do a cost benefit analysis over 10 or 20 years, it's
doesn't always make sense.
Doesn't always make sense. Yeah. Sometimes it's good for lending because lending can be distributed because some lenders, if you've got property in a trust, for example, and you've got a property outside, if the trust kind of self-sufficiently kind of takes care of that property and that debt, it won't be included on any personal lending. So you can actually get more borrowing by having them split up. However, once again, should you be doing that? Is that right for you? That's a whole another discussion.
Yeah. And then also too, I suppose if it's a property that you're going to go live in at some point or plan to live in, then it's harder to get those capital gains tax exemptions for primary residence and that sort of thing too. So a few things to be aware of when we're going down that path.
There's a lot of good sides, and we don't want to kind of not look at them. I've got a few of them, and I've got them for clear reasons, with clear goals, with clear understanding of why they're there. However, they're not for everyone. They're not for everyone. And I think this is where I was talking about those buzzwords. It's like, I've heard about debt recycling, I should do it. I've heard about a family trust, I should have one. And it's like, no, I'm going to say all cases, but in a few cases, we see people set these trusts up and then never use them because there's better ways to kind of do things. And so, just think carefully. Think carefully around, do I set it up? Is it right for me? Get the right advice, financial advisor, accountant, potentially lawyer, which we'll get to in a moment around the estate planning pieces. And then those roles. Like those roles are really crucial. We utilize them for this, like the protection element. We utilize them for so many different things, and it's so important. So important. I can't stress to you those roles, how important they are, the appointer, the trustee, and the beneficiaries. So getting onto that around estate planning and around asset protection, what are some of the benefits, JK, of this?
Yeah, so when it comes to, like I sort of said earlier, it's this entity that kind of stands on its own. And so a common reason why we might use trust is not just for those tax benefits, but also these asset protection benefits. And common example is you've got someone that's self-employed, they're running a business, any, say, assets outside of that business that we're building up, you normally would want to try have them in a separate entity, for example, a family trust. And then you kind of want to have it in a way where the person who's the director of the operating entity or that business, you kind of don't want them to have any control or like linkage in the trust. They can be a beneficiary, but you don't want them to have really the role of the appointer or the trustee. So you're removing that link between that person and the trust. So if that person ever were to get sued, it's very hard to say, well, that trust is controlled by that person, therefore we can liquidate the assets in that trust.
And then that individual is sole entitled to that money that's being flowed through. And that's the key. So control and beneficial owner, let's call it.
Correct.
Because people sometimes will go, but I've got a family trust and, I should be right.
Not necessarily.
Not necessarily, because like if you are then in control of that trust, you've got complete control of that trust, and it's just a vehicle that's literally flowing money directly from one entity to the other, and it's flowing through. I wouldn't be saying that you can sleep at night if you're up for a big thing. And this is where lawyers, and I've had Lucy Percy on around this, and Tara Lukey as well too previously, around just like how important it is to get these right. And so it's, if done well, very protective.
Yeah, correct.
Not bulletproof.
No.
Not bulletproof. Yeah. I was having a conversation, I can't remember who it was with, and we're talking around like, if someone, let's say you're in a marriage and, we've got all of these assets in a family trust and, I marry this person, can he or she, come up to grabs with all of that money? Well, it depends. Well, first and foremost, the family law court has a magic wand that can kind of go, okay, well, cool. Forget the entities for a second. Is the person in control? Is the person the beneficial owner? Has he or she been benefiting from that trust?
Yep.
Has the person been dependent on that income, on that, and has it been regular? Has we seen patterns? And if you kind of take it out like from the emotion of the person, it's a pretty fair approach. Like to say, hey, listen, let's just wipe out all of these structures And let's actually see what's really happening here. Yeah. And what we don't want to see from a society perspective is we don't want to see people setting these structures up, say having a divorce, having a separation, and then someone's on the street. Someone's got all of the money.
Correct.
Kids are struggling to eat or whatever. And like, I don't know about you, my ethical compass, I do not want that.
Yeah, correct.
You know, I want a fair system. I want a fair system. No, I don't want the person who comes into a relationship with 10 mil and then someone has nothing, you know, being with them for 3 weeks and then they're entitled to the whole thing. I think that's unfair as well too. And that's where, like, people sometimes say to me, all right, well, no, I want it bulletproof. I'm like, yeah, you can kind of get it as watertight as you can, but
it's never going to be completely.
Never going to be completely. And there's certain things around, like, what you've done on the lead up to these creation of these things. How did money go in?
Yeah.
A big one that people think that they miss is beneficiary loan accounts.
That's a massive one.
Beneficiary loan accounts is like, let's say I have a family trust, and to set up or to buy an asset, let's say the asset's worth $500,000, we're buying a property, and I've tipped in from my own money into that trust $300,000. Well, that trust now owes me $300,000. So yes, it's a debt on the trust side, but it's my asset. Yeah. So, like, I can call that in. You know, so what's the risk around that? Yeah. And like also the flip one around that is around, like, so I've owed money, and then also has the beneficiary actually paid out? Sorry, the flip side.
Correct.
And sorry, I started the opposite way. Sorry, everyone. Was like, what about the flip side? Let's say I wanted something personally, and I needed the $500,000, and then the benefit, and then the trust spits out the money to me. Me individually, I owe the trust money. So the trust now has an asset on its line item, and I have the debt. And so if someone sues the trust or the entity or whatever entity, well, technically,
They've got the asset.
do I owe it? So then, like, do you get me what I mean? So they can call that in as well too.
Correct.
So, you know, there's been times where I've seen trusts where they have these millions of dollars because it hasn't been managed. This hasn't been managed, and there's these huge swelling beneficiary loan accounts that get accumulated because these trusts are distributing all of this money. Very common one is simply like distributing on paper, but not physically
sending the money.
You know, and when you do that, that's what's ballooning these beneficiary loan accounts.
Yeah, spot on. And then also too, when we talk about, like, you know, we said earlier, you can have beneficiaries as pretty much anyone. Doesn't mean you want to necessarily distribute to your next door neighbor, because then they've potentially got a beneficiary loan account, which means they've got an entitlement to the assets in your trust because you said you were going to distribute them, I don't know, $100,000 to save on tax, and they didn't physically get that $100,000. Technically, the trust owes them $100,000.
Correct. And then also what the impact of that distribution is. Yeah. Are you distributing to elderly parents that are on the age pension? What's the impact on that?
Yep.
Are you distributing to households that are going to then go up to Division 293 taxes? Are they going to lose Medicare levy, not Medicare, like, you know, benefits on their, you know, private health insurance? They're now going to be going up to a higher tier. What's the impact on those beneficiaries? And I think that's another area that people don't look at around those beneficiary loan accounts. And also the true impact. Mate, one is, for example, in Victoria, we've got the solar rebate. On, like, creating solar, batteries, whatever. There's an income threshold for you to do that. Person might lose out on that, lose out the ability to kind of do certain things, and there you go, there's 10 grand, say, I don't know, I'm just going to throw 10 grand of rebates that you've lost because of that distribution pattern. So, you know, a lot of the tax planning that we do, we usually bring in the client's accountant and working with the accountant, the client, and us around distribution patterns. And then the impact at both the, let's call them the primary beneficiary level, but also at the secondary beneficiary level when we're getting down to that level.
Correct. Yeah, correct.
So they can be complex. But for the right people and situations, they're very handy.
Correct.
They're very handy. And I was speaking to an accountant on Wednesday, actually, around, like, there's a lot of accountants or even individuals that don't consider them based on their current scenario.
Yeah, that's a massive.
Yeah? So it's like, I don't need it now. But like what we need to do, and this is where I think we have this advantage in regards to forward-looking tools, is around, well, okay, cool, but what's the position that person's going to be in 10 years from now? Because if we've bought assets now, and we should have bought them in a trust, selling those assets and then moving them out, like, hey, I've got my assets in a trust and I want to now move them to my own name, that's a very costly exercise. Very costly exercise. So the ability to see 10 years, 20 years from now and what assets are going to be held, that's very important around, is it right for me to have? Another one as well too, which is a myth, that I want to kind of raise here, is around like, oh, can I get my employer to just pay to my family trust? I don't get it so often, but I did in the past.
Yeah.
You can't, JK, can you?
No.
Yeah. And so, I just want people to think about, like, especially high income earners, that I know you're battling with tax and I know it's a huge one, but like, no, that's not how it works. Yeah. Not how it works. And if you are on PAYG, so if you are employed and you're not self-employed, yes, trust can still be a very advantageous thing to happen because of what we just spoke around, the ability to build assets, and you want your assets to be held in the most tax-effective ways. And so we've got to consider that. As much as we consider super contributions, superannuation is not just another tax structure. It's actually a trust as well too. But with special provisions. Where is that money zoned? Where is it held? And so I think it's just something that needs to be considered, but don't take this lightly. Don't think it is for everyone. Get proper advice, do it properly, and it can be very beneficial for you.
Yeah, absolutely. And there's also, I suppose, I think, which is what you were alluding to, like PSI rules within a trust. So if you're operating, let's say you're operating a business out of a trust and you're a one-man show, you don't have any staff, you don't really have a lot of other assets within that business that are generating the income for you, then regardless of how you're structured, whether it's a trust company or, you're a sole trader, all that income, let's just say it is in a trust, needs to be distributed to you because that income that's generated within that trust is a direct result of your personal exertion. So there's some of the scenarios where it's like, well, yes, you've got a trust, but it doesn't mean you can automatically just distribute to anyone that you want.
And you see this a lot in like the medical. You even see it in the finance, like, a single operator, that's like you said. So a lot of people, I think that the difference is are you like a contractor? Are you like a self-employed, you're earning money and you're exerting your time? Or, for example, someone like me, 20 odd staff. This is what Thriving Wealth does. It's not a direct correlation to just what I do.
Stand on its own to a degree.
It can stand on its own. The profits that business is having is non-dependent on my personal exertion. Yes, I'm adding to it, but it's not solely dependent on me. But I don't know, let's say you've got a dentist, that's contracting through a trust to one particular provider or even particular providers, but just providing his or her services, that's where PSI rules kind of come in,
Yeah, correct.
Yeah, great one to raise. Now, this is obviously a very hot topic. I see it all over socials as well too. So hopefully you've enjoyed this episode to really understand a little bit deeper around how they work, the roles, some of the pros and cons around this. But I want to emphasize getting professional advice from your accountant, lawyer, and financial advisor is the most appropriate way to approach a family trust. So hopefully you're enjoying these episodes. If you are, make sure you like and subscribe and share this on all major platforms on video like YouTube and whatnot, and Spotify and Apple Music and stuff like that as well too. So thanks very much for watching again, and thanks JK for joining.
Thanks, mate. Thanks, everyone.
Cheers.